Welcome to the Bigger Cashflow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
What's up, you guys? Welcome to another exciting episode of the Bigger Cashflow podcast. Today, I have MC Laubscher. He is the creator and host of the popular and top-rated business and investing podcast, Cashflow Ninja. MC is also the president and chief wealth and investment strategist of Producers Wealth, a wealth creation firm that serves investors, entrepreneurs, business owners, and professionals in the United States and Canada. His purpose and mission is to help producers and creators create, protect, and multiply their wealth in any economy and market outside of Wall Street. He has shared these ideas as a guest on several podcasts and is a regular contributor to Grant Cardone TV, LinkedIn Pulse, and Bigger Pockets. With that, let's welcome MC to the show.
Hey, thank you so much for having me. Honored to join you on your show.
Yeah, very excited to have you on the show. Why don't we dive right in? And can you tell our listeners a little bit about your background?
Yeah, so I'm originally from South Africa, so came to the U.S. as an immigrant in 2001 with one suitcase, a backpack, sense of humor, sense of adventure, you know. And I played in a sports league up until 2007. While I was playing sports, I found my purple book moment, as I call it. They found Rich Dad, Poor Dad. My mom actually gave it to me to read. And that just took me down the rabbit hole, started researching, studying as much as I could. I found a mentor along the way as I got into playing sports in the U.S. I didn't know I was supposed to be looking for a mentor, but I found one in the real estate space, learned the multifamily real estate business from the ground up, still traveled, played, studied as much as I can. And then started to implement a lot of the strategies that I've learned while I was studying in my own life. And I saw massive improvements. And I started to see results from the things that I was doing on a small scale. Fast forward, though, so right now, as you mentioned, I have a show, the Cashflow Ninja. I'm the creator and host of the Cashflow Ninja podcast, where we interview Cashflow Ninjas that share how to create income in the new economy and in the information age. And I'm the president and chief wealth and investment strategist of Producers Wealth, where we help people create, protect, and multiply their wealth in any economy outside of Wall Street and in any market. So I'm honored and blessed to do what I do and enjoy and doing it every day and loving it.
That's awesome. Awesome. So it looks like you found Rich Dad, Poor Dad, and that kind of triggered, this whole journey to creating more cash flow and taking that control back from Wall Street. Why is this so important? Taking back control. I know I harp on it multiple times on this show, but I'm curious to get your take on it.
Yeah, I think for your listeners that's not familiar with Rich Dad, Poor Dad, so Robert Kiyosaki had two dads. He had a rich dad and a poor dad. And the rich dad was the father of his best friend. His poor dad was his real dad. So his rich dad, as he calls him, was one of the richest men in Hawaii, an investor and a business owner. And his poor dad worked for the education board of Hawaii, right? He was a teacher. And he learned different things from both men. None was better than the other. They were just very different. And it's a very different approach to life. And I think what the book does is it expands your context and the way that you think. You start thinking about your thinking like, wow, money is an idea, right? You didn't learn, oh my goodness, there's some magic pill that you just took that money is an idea. It opens up possibilities and challenges your thinking, because if money is just an idea, all of a sudden now it switches to the abundance mindset, because ideas are abundant, which means money is abundant. Because if you think money starts with an idea, then it jumps into what problem am I solving? What outcome am I trying to create, right? Because that's why businesses and investments exist, for those two reasons. Then you get a team, you acquire a skill, and you create an elegant solution to solve a problem or to create an income, take it to the marketplace, you're successful, and the end result is money, but it all started with an idea. So with that example, I think the book challenges your thinking and expands your context, and then you seek more content now that you've changed your mind, because we're all wired a certain way, especially when it comes to money. We're hardwired a certain way. We have certain beliefs. We have a certain worldview. We either saw mom and dad fight about money and never had enough money in the home. Maybe there was a dad that went bankrupt and had a business, right? Like all these different experiences folks have, and it ties into your belief and what you feel and what you think about money. So you got to change the way that you basically, I think, a good way to say it is you have to rewire your brain, if that makes any sense, right?
Yeah.
So you have to get a new operating system, if we use the computer terminology, and then you can add all the different apps to it, which is the content. But you got to change the way that you're wired, and you have to change the operating system. And I think that's what that book does so well. It's the same. I mean, there's core different lessons. The same can be said for The Richest Man in Babylon, right? Think and Grow Rich, the science of getting rich, like all these different books that have been around, over 100 years, some of them, right? But the principles and the way that it changes the wiring of your brain and your operating system still works to this day. And I think that's why that book was so important.
Yeah. MC, as you know, I'm a huge fan of your podcast. And when I signed up for your email newsletter, you actually sent me a copy of The Richest Man in Babylon. And I believe I read that in one sitting. And I just realized that, foundational book is actually prevalent in a lot of these personal finance books that are being popular now. It's very simple concepts that, once you grasp it, your mind shift changes. And you have to wonder why schools are not teaching our students this, because I certainly didn't learn about money, how to balance a checkbook and things like that. You just learn to be a good worker, which is something that, you mentioned a couple of times on your show as well. And I think it's so important that we start to change our mindset from whatever Wall Street has told us is the definition of retirement into cash flow and living your best life now instead of delaying it 40 years later.
Yeah, absolutely. Like you said, the big core message out there that I'm talking about constantly is that you're not going to learn anything about money in schools, and you're not going to learn how to protect it, and you're not going to learn that mindset of abundance, because the whole school system, I mean, I can talk for this for a while, but one of the core things that it teaches people is the mindset and the worldview of scarcity, because there's only in the industrial age, school's an industrial age model, and it's based to serve the industrial age, right? You mentioned we were taught to be good worker bees in the factories, basically, right? For the industrial age model. And there's a lot of scarcity that existed there. There's only a certain amount of hours per day, a certain amount of goods and services, like all these scarcity kind of things that existed in that world. Well, we don't live in that world anymore. Like I said, the abundance switch, if you start to understand that information now, data is the power. That's where the real power lies. And data and information is abundant. I mean, just think of how much data is around there. And the same with if you translate data to the individual, and on the individual level, data is ideas, and it's information that you retain. So there's an abundance of information that you can retain and knowledge, and there's an abundance of ideas. Hopefully we never run out of ideas, ever. Every single one of us, because that would be the definition of hell for me personally.
Yeah.
But yeah, I think that schools don't serve people. I think that money is not taught in schools, and it's done by design. So once you get out of school, and some people even they go to university and they have master's degrees, they still don't know anything about money or how money works, which is, it's very, very sad, but we're trying to change that. And that's one of the big problems that I've seen out there. But with shows like this and information that's now abundant on the internet, you can find it, you can learn, you can rewire your brain, you can change your worldview, and you can change everything in your life, really, if you take action and make a commitment to do so.
You're an educator, and I see the passion in your voice. So once you have this knowledge, what can we do as W-2 workers or small business owners, entrepreneurs, to protect our wealth and just grow it in perpetuity?
Yeah, that's a great question. So here's the big challenge that I see a lot of folks have. So they go through everything, they read, they expand, they listen to podcasts, they do all these things, and then now what? They get to a point where it's like, okay, well, what do I do right now? And then it's, maybe they would get a mentor, they would hire someone, or they would just fall on their own, which I kind of did before I smartened up and wisen up and got mentors, right? But I think the next step then becomes, okay, what is a practical way to develop a plan, and not only a plan, a strategy? And that's the next step, because a strategy can be personalized to your goals and what you're looking to accomplish and what you're looking to achieve. And you'll notice I say strategy. I did not say products or vehicles and so forth. We're looking at the golf swing here. If I read everything about golf and I watch Tiger play every weekend and I'm excited and I want to get started on golf, what do? We go to the range and we start learning how to play golf by picking up a club and practicing a swing and getting our swing sorted, right? I don't go into the most expensive store and start picking out golf clubs, because that's the next step. That's going to determine my success. But that's how we're programmed to think about things. We're programmed to think, okay, should I invest in stocks? Is stocks a good investment? Is real estate a good investment? Is gold and silver a good investment? Is Bitcoin, so it leads with, what golf club do I now need that's going to be the golden ticket, right? Like in Charlie's Chocolate Factory.
Yeah.
Instead of thinking, what's the strategy? What are my strengths? Who am I? What is my mental capital? What do I know? What are my experiences? What are my knowledge base? What have I read? What have I studied? What are my interests? What stuff is aligned with my investor DNA? And what I mean by that is, I like real estate and insurance, and I know we're going to touch on that in a second. The reason why I like those two things is because they move slowly. That's aligned with my investor DNA. I don't like to go to bed and wake up the next morning and all of a sudden the entire world just flipped, like a Bitcoin. You go in to sleep and it's 20,000, you wake up and it's zero. That moves a little bit quicker. Real estate moves slowly. You can see trends, you can anticipate. Insurance is the same thing. They've been around for, a long time. So they're very predictable. That's aligned with my investor DNA. That's what I mean. And then the other thing is your mental capital times your relationship capital. You bring in that. Who do you know? What mentors do you have? What people do you know? Who's in your network? All that kind of stuff. Well, now that all plays into the foundational stuff of, what do I need to incorporate in a strategy? So for some people, they're entrepreneurs. They like to start businesses, even if they're W-2s as side hustles. For some people, they like to invest. They like to, investors are also business owners in a sense, because you're providing a service or a product, right? A service being affordable housing for folks. So you have that part of it. And then there's a whole part of it. I think you touched on protect. We talk about creating, protecting, and then multiplying. You have to be able to create. That's the business, the investment. Because again, money is an idea. Ideas are plentiful. So you create, and now you got to protect. And where protection comes in is protecting not just your obviously your assets, but also your money, which ties into cash flow management systems, because money has to reside somewhere, right? And where you eventually warehouse it. So I'll give you an example. I have a business that provides cash flow. Where do I put that cash flow to protect it, to then leverage it to invest back either in my business or in investments? Because there's an in-between step. And I think that's what a lot of people kind of miss. This is one thing that I even see in the entrepreneur and investor space, and what my company is trying to address is there's not a lot of personal finance for investors and entrepreneurs. They're being taught the same stuff as everyone else, and they're completely different people, wired or DNA, if you want, than the rest of the folks. So the financial advice that 99% of the people follow is not going to work for investors and entrepreneurs because they don't live in that world. They live in different worlds. So what we do, and I know you had mentioned touching about on this a little bit, is we use a system where we take insurance contracts as part of our overall strategy to incorporate a cash flow management function within it. And that's where we, quote unquote, warehouse our money from our cash flow, whether it be our businesses or you mentioned W-2s or the employees before we invest it back in our businesses or then into investments.
Yeah.
So that's kind of what I would touch on. I think to shorten my answer that took a long time to explain, I would say the big takeaway should be strategy first, product second, and then there's moving pieces that should be aligned with you because you're your number one investment.
I totally agree. Even when investors reach out to me and ask me, hey, what are the steps to get my first rental property? If we're framing this conversation in the mindset of a buy and hold real estate investor, I tell them step number one is getting your mindset straight. And it's not just a bunch of woo-woo, like Tony Robbins get you excited thing, but it's that important of getting the right mindset and making sure that you have a good strategy, like you said, before you step out and go research markets, underwrite deals, and place it under contract. All that stuff is not as important to me as getting your mindset straight and getting your strategy straight. Because if you don't know what you want, any road will take you there, right? So you want to make sure you know where you're going, and this is why you're going down that path. And, full disclaimer, I work with MC because I reached out to him. I know he does this infinite banking concept, and I wanted to incorporate that as part of my business because, as you guys know, I am in the rental residential space, and I wanted to have a strategy where I can place my cash flow and have that grow and utilize that money again into my business, because if the market turns, or when the market turns, I should say, you want to have that dry powder. And I personally felt like that this is the best way to have that money when the banks are holding tight onto their pockets. You're going to be able to use this to infuse cash back into your business. So with that said, if you can give our listeners a 10,000 foot overview in terms of what this is, because as soon as you say insurance, a lot of our listeners might be like, oh, I heard bad things about insurance. You should only get term and invest the difference, or whatever, they've been taught. So how about you give us a 10,000 foot overview and we can dive in a little bit deeper.
Absolutely. Did you say insurance? I just heard a bunch of people press stop. Yeah. So here's the thing about insurance. Insurance is just like real estate. It's just like any other asset class. So there's certain strategies that determine success in it. So I'll give you an example. People would say, is real estate a good investment? I know people that have lost everything on a piece of property, and then somebody buys that exact same property and it's a home run. How is that possible? Because of the strategy, right? The mindset, the experience, the team, and the strategy that the person has in implementing and executing it. All the other asset classes is the same. I joked about Bitcoin. I know people that have lost everything, that there were people mortgaging houses to buy Bitcoin in end of 2017. They lost everything. And then I know people buying islands in the Caribbean right now, or portions of it, with what they did in Bitcoin. Same thing, strategy, not product. Let's hit on insurance first a second. Now that we know it's the strategy, it's not the asset class or the vehicle. The second part of that then becomes, well, why are some of these opinions out there about it? I'll give you an example. Dave Ramsey says, for example, whole life insurance, the vehicle that we use, is one of the worst places to park your cash in, right? Susie Orman said the same thing. But then you have family offices using the exact same vehicle to warehouse legacy wealth as part of a cash flow management system for families with a net worth of $250 million and up. Where's the disconnect here? Dave says it's bad, but it's used by these families, a completely different strategy. The way that it's sold and packaged for the majority of the public, like Dave Ramsey said, it's horrible. It's a horrible place to park your cash. I would agree with Dave and Susie. But if you tailor a different strategy and you use it different and you structure it different and you incorporate it differently into an overall strategy, it could be one of the most powerful places to put your money. I know I've been doing that, for a while. So, and that's what I've personally done with my investments, my business, like my cash is parked inside these contracts. But to give you a very, very high level overview of the strategy, it's called the infinite banking concept, because you're essentially implementing the same principles that banks do. And you're reclaiming the banking function, meaning you're taking banking now to the individual level, the me and you level, where you're a depositor and a lender for yourself, and you get to profit as the owner of the strategy, the way that banks do it themselves, right? So you use a dividend-paying whole life insurance policy with a mutual insurance company. Mutual insurance companies are not stock companies. They've been around for 150, 200 years. They're very, very, very secure. They've been around. They manage their company very well. They're outside of the casino. They've paid dividends, some of these companies, for over 150 years consecutively. And we use this whole life insurance policy that we overfund, meaning we're structuring it for max cash value, not just necessarily the death benefit. We're using it for the living benefits, the life insurance, not just the death insurance, as I call it. And that's where we warehouse our money, and we put it there because it's guaranteed. The principal's guaranteed. The growth is guaranteed. You get dividends, which is not guaranteed, but like I said, they've been paid consecutively for over 100, some cases 150 years by companies. You have tax-free growth in this vehicle. Tax-free growth, there's a death benefit, and then, of course, you get to access the money at any time for anything through a policy loan without a credit checks and all these other things. So that's kind of where it ties in. It's also private, and it also has asset protection in the majority of the states in the US. So you have all these things, and that's the reason why we warehouse it there. But the most powerful thing is the ability for the same dollar to do multiple functions, meaning that you deposit money into this policy. It's guaranteed, it grows tax-free, but you can leverage that money by borrowing against the cash value in the policy to then use in your business and your real estate. For some of your listeners that just went, what is he talking about? Leveraging, borrowing against. I'll give you a very simple example. In the 70s and 80s, interest rates were very high, double digits. So if you actually put money in a CD in a bank in the 70s and 80s, they would pay you, let's just say, over 10%. There's some people that got 15% in it, but let's just say it was 10%, right? So if you put 100,000 in there, they pay you 10% per year. If I then went back to that same bank that I had the CD with and say, Mr. Banker, you have my CD of 100,000 there with you. Can I get a loan from your bank secured by that CD? The banker would say, well, of course. Your money is in my bank. It's collateralized. So what I essentially did there, and let's just say he gives me 90,000, which is 90% of the 100,000 that I have with them. The money that I have is secured by my CD that's in there. I essentially leveraged the money that I have in that CD through a loan, because the loan is collateralized by my money. So the $100,000 is still there, growing, uninterrupted. I didn't draw it down or take money from it. And I had the ability to take the 90,000, 90% of that 100,000. And now I go invest in real estate, creating cash flow and then paying off that loan. That exact same strategy that I just explained is what we do with an insurance vehicle, because it has all these other extra goodies on top of it. The tax-free growth, it's a financially invisible vehicle, and so forth. But I think that's just a brief overview, because we could really get lost in the weeds. But that's kind of an overview of the strategy.
So let's kind of dive a little bit more into whole life insurance and like the logistics of it. So, you mentioned a lot of good things about, asset protection and how you can use that vehicle to leverage your money, all that good stuff. So insurance companies, they've been around, like you said, for 150, 200 years. So for the skeptical investor, what if they are thinking, what if the law changes? Or, because a lot of people are afraid, right? So would there be any chance that the law changes to impact the contract that you have with these insurance companies?
That's a great question. So there's four types of risk. The first is political, then we have economical, we have market, and then we have institutional. So let's start with the political risk. Where do the majority of the wealthiest families in the United States warehouse some of their cash as part of a cash flow management strategy? You know, the family offices is inside permanent life insurance contracts, right? Where do banks are actually some of the biggest purchasers of life insurance. Most people don't know this, but their tier one capital, which is their safest capital that they can have, they all put in these contracts. You know, I could say the same with corporations. All you have to do is Google, the executive packages that, for example, Jeffrey Immelt walked away with at GE. It's a life insurance contract that he walked away with. Most people would just look at it and not really understand what it's about. It's the strategy that we're talking about. So what I'm saying is there's a lot of very politically and powerful people connected to this with a very strong lobby. So when you're positioning yourself in asset classes, and you want to be aligned with powerful people and do the same thing. And I think that's the message on my show as well. We don't make the rules. I mean, what are we going to do? Complain about it or whine or, moan about it? No, we look at what the rules of the game the games are, and this game is, and then we play by the rules. And there's a blueprint of how to play by it, following the blueprint of legacy wealthy families, banks, and financial institutions. We play by the same rules that they do, and we copy and paste what they do. This is not an original strategy. I didn't create this. There isn't other folks that created. We just looked at what the wealthiest folks are doing and did the same thing. So that being said, I think will the rules change? It's going to be very, very tough because there's a lot of powerful, I would say, interests on the side of keeping it the way that it is. And even if it does change, I mean, this stuff has been around a long time before 1913, before the tax law. Even if it changes, and the tax law does change, the strategy is not going to change, and there will be other things that we could look at or implement. I mean, there's always ways to change and adapt strategies and be flexible, right? To get the outcomes that you want. So that's not something that I'm very, very concerned about. Will things change with insurance companies? Because you have the economy risk, you have the market risk, and the institutional risk. No, I mean, mutual insurance companies are some of the most well-managed companies out there. Insurance in general is a very good business model. That's why Warren Buffett loves it. He started with a hedge fund. Then he kind of went into banking, and then he saw the insurance model. He's like, I'm done. This is the end all and be all, right? So they get all the premiums up front to invest in conservative investments. Mutual insurance companies don't have to take risk, like, for example, stock companies. So they're not going to run into issues like AIG with doing very, very risky things. So yeah, from a risk management standpoint, I mean, I play around with all types of different scenarios, and it just, like I said, this has been around. Great Depression, market crashes, times of high inflation, in the 70s and the 80s. It's seen a lot, and it's still been a very powerful vehicle. So to plug into your overall strategy, I think it's a great piece of it to supercharge your cash flow management system, and a great place to park money until you use it for investments or in your own business.
Yeah, no, I love it. You certainly know your stuff. So why haven't investors heard about this? Can they just go to their local, Allstate or Farmers insurance company and just ask for this? Is it like plain vanilla, or is there something that they need to be aware of when implementing the strategy?
You'll be surprised how many angry emails I get, because they listen to this interview, right? And then they go to their brother-in-law that works for State Farm, and he says, oh yeah, I can set up a whole life policy. And then they set up the policy, and I get an angry email saying, MC, this is nothing like you discussed and what you talked about. So yeah, I've actually jokingly made a video on YouTube about this, saying why infinite banking is a scam. And that actually got a lot of hits, because people are like, yeah, I got ripped off by my insurance guy. Well, here's why it could be a scam. Number one, it's not set up with the right company. It has to be set up with a mutual insurance company. Number two, it's not set up with the right agent. There's only a number of agents in the country that have been trained and actually structure this. You want to be with the right person, because it's very, very important of what I'm going to say next is there's a lot of good people out in financial services, so I don't want to bash anyone. But what I'm saying is you literally cut down your own commission by structuring it this way significantly, in some cases by 75%, right? So that's why you want to go with someone that is, for example, an infinite banking practitioner, because they have the abundance mindset. They're structuring these policies as it's supposed to be structured and set up. And that's the third piece. The first piece is right company. The second one, right agent. And the third piece is correctly structured. Structured where you have maximum cash value available year one, and you can borrow money within the first week, basically, if you wanted to, against that policy. So let me give you an example. $100,000. And again, this is not I'm not brushing this with, I'm not painting this with the same brush over, because there's different ages, health ratings. Everyone's different. They live in different states. They have different scenarios. But in most cases, if you put in $100,000, you're probably going to have around 70, 75, 80, depending on your underwriting, available immediately that, within the week or however long that takes to clear or get set up. And you should be able to access 90% of the cash value of that money within the first year. So a lot of other insurance contracts, for example, that folks have seen, they probably didn't have cash value for the first 3 or 4 years, because that's how they structure most whole life policies. So yeah, insurance, trust me, I thought I knew a little before I started getting into it, because I came into this not from financial services, but as a real estate investor. And I realized that I didn't know anything about insurance, that I was very ignorant about insurance, because it's one of those things that nobody thinks and picks insurance and goes, oh, this is going to be a great topic. I'm going to research and study insurance. No, we just don't think about that way, because it's not sexy. Willie Loman, The Death of a Salesman, was an insurance guy, right? People crack jokes on a lot of Hollywood movies about insurance people. You always feel sorry for the insurance guy, So insurance is something that not a lot of people know about, I would say. I myself was very ignorant before I really started deep diving in and learning everything that I could about it. So I think the general public out there doesn't really understand the living benefits. They know, number one, that they don't like to pay for insurance, like car insurance and health insurance and so forth. And number two, they just think that it's all about death benefit, and they don't know as much about living benefits. You could structure private pensions with this. There's just so many different strategies with high cash value life insurance that you can do.
Yeah, I think there's two key concepts that you just mentioned that I want to unpack there. Number one is it's a living benefit, right? So typically a lot of these insurance policies, they're set up to pay you once you pass. But, little do we know, we can strategize and, set this up where we're taking advantage of it like our own little piggy bank, like the example that MC gave us with the CD and leveraging that account to create even more wealth for generational wealth. Number two, if an investor has gotten over the mindset hump in terms of they're not going to get a term and invest the difference, they're wanting to set this up. There's the whole life group, and then there was the indexed universal life group. MC, I'm wondering if you can kind of speak to us a little bit about that, because based on my research, the indexed universal life group, I actually had a family member who had this policy who came to me when I was researching whole life, and they said, hey, Bo, they cap the downside so that you don't go into the negative, and you follow the stock market, and look at the stock market. It's doing so well. I don't see any downsides to this. I'm curious why we're specifically looking at the whole life and not indexed, and if you can kind of compare and contrast.
Absolutely. The first principle on insurance, and I learned this from a mentor, is there's no deals in insurance. A quick primer on term. Term is for a specific term. So it could be 20 years, 30 years. Most of it is 20 right now. But basically, that's a bet between you and the insurance company that in 20 years, if you're alive, they keep the premiums. But if you win the bet, which you never want to do, because then you die.
Yeah.
Yeah, they pay out a benefit to your family. So that's term insurance. Whole Whole life insurance is for your entire life. So it's more expensive than term. Again, there's no deals in insurance because it endows, meaning it will pay out. If you get to live to 121, they write you a check, right? If you pass away, money goes income tax free to your heirs, right? Or your beneficiaries or your estate and so forth. So that's whole life insurance. It's for your entire life. Now, something interesting happened in financial services in the 80s. Ted Benner, which I interviewed, created the 401k, right, based off the ERISA legislation. So what happened? A bunch of 401k plans were incorporated in the early 80s. I think 1981 was some of the first ones, right? The average person was never available or able, rather, to invest in the stock market. Before that, think about that, right? So I think a lot of millennials, especially because of the history, a lot of people go back, they don't quite understand that the average guy did not save his money for retirement in the stock market like is basically touted as gospel right now, right? This happened in the 80s. So what happened with the baby boomers, especially during that time? What happens if 76 million people, and that's just the baby boomers, all put their money in the markets? Well, you had the biggest explosion and boom in stock market history, right, before the 87 crash. Now, what happened? Insurance companies looked at this and go, how do we get in on this? Like, this is the biggest party. We got to get a ticket to this train because this train is taken off. How do we get in on this? So they created, and they said, the smart guys sat around, math was, and said, if we could take term, convert, renewable term, and we combine it with a bundle of stocks, now we call it, universal life, basically. Now we've got a ticket, we've got the magic bullet where you have life insurance, but you have the ability to participate in this massive boom. Very sexy. They sold a ton of this stuff because it's a sexy pitch, right? Hey, how would you like to invest in the stock market and have life insurance? Only get the benefit of the upside, 12%, and the downside is 4%. Most people would say, well, that's a no-brainer. There's no deals in insurance, remember? That's the first principle I just said. You have a renewable term insurance portion to that, which means it renews every single year at your age that you're at that stage, right? And again, I'm not going to touch on the Wall Street side of it, but the fees are outrageous on the mutual funds that it's in that bundle. So what happens is, in short, is that these policies blow up because the insurance costs skyrocket when people get older. And that's why you have all the lawsuits right now. All you have to do is go to a Google search engine and type in Universal Life lawsuits. And there's going to be articles and articles and articles. I think there was one just last year with Transamerica that just settled for $180 million. And it's the same story over and over. Our insurance costs skyrocket so much, it ate away all of our gains. Nobody told us this because the people selling it didn't tell people that this was going to blow up when they get older. When you're in your 20s and 30s and 40s and 50s, it could be great, but when you get to your late 50s, your 60s, your 70s, these things blow up on the back end. Most people have probably heard about this where they said, some policies don't pay out. I've heard that before, right? Some policies don't pay out. Here's why they don't pay out. It was a universal life policy that mom and dad had, and they told the children that they had these policies. But what happened was mom and dad got older. It became unaffordable. They didn't tell the children, hey, we can't afford these premiums anymore because they're outrageous. So they let them lapse, or they surrendered or try to get whatever cash they had left out of them, right? And then mom and dad passes away, and the children's like, well, where's the life insurance? And then they call the companies, well, this lapsed, so it didn't pay out. So now you have like people angry and, going on the internet and calling, what's the is it Nightline? Is that so that's where that kind of stuff came from. So what I would say is, number one, there's no deal in insurance. Number two, you have to be very, very careful because there's a lot of things that they're not telling you. It's very, very sexy. It sounds like there has to be a catch, and there is definitely a catch. And this is only, Universal's been around since the 80s, right? Whole life's been around for over 100 years, close to 150 years with some companies. It's been around for a very long time. It's gone through all these big tests, right? High inflation, market crashes, Great Depression, all of these things. And that's why when you're looking to build a house, I like to build a solid foundation and have a house of bricks, not of sticks. And that's why whole life fits in really well with the infinite banking strategy. Infinite banking, if somebody tells you that universal life could work for it, trust me, being part of the infinite banking and Nelson Nash Institute and that community, absolutely not. By any way is that a good fit. And that's what any authorized infinite banking practitioner will tell you.
Yeah, this is very important because I've gone to RIA meetings where they pitch universal life as infinite banking concept. And, they fail to tell me that it renews every year like a term. And I think that's a huge piece because, they might be pitching, hey, maybe the gains will outpace the cost of the premiums or whatever in the future. But I can only see once you hit a certain age, it's going to cannibalize your gains and it's just going to eat away at it from the inside. So that's a huge difference that investors need to evaluate and consider before, moving with one or the other.
Yeah, you want to be educated in it. There's a lot of salespeople out there, and we sell as well. We're a company and we're in business,
Yep.
but our mission is very strong. So I'm very blessed that we have a lot of folks reaching out to you because we put so much education out there first that we don't have to hard sell anyone. Insurance should not be an investment. Insurance at most is a quote unquote savings vehicle. I've heard it called all types of things. And every single year there's someone else coming out with something new, right? You want to be very, very careful, get educated, learn as much as you can, and also know that there's no deal in insurance and you have to know all the different aspects of it. So that's that's what I would say to your listeners out there as well.
We definitely covered a lot of ground today, and we're definitely going to have you back on the show to share more and educate our listeners. But just to quickly recap, we talked about how the rules are no longer the same in our parents' generation or our grandparents' generation. We no longer have to have the scarcity mindset, and it's data. It's all about data that's out there, and we can take that control back into our hands. And you no longer have to, follow the Wall Street designated retirement definition of, working for 40 years, investing in your 401k, accumulate, and hope one day at 65 it works out, right? That's why, the Cashflow Ninja is here talking about how it's important to create streams of cash flow instead of just accumulating and hoping in 40 years after your best life has gone by that you're able to retire, right? And next, we talked about the infinite banking concept of, the differences between term, whole life, and universal index life, and the differences, the pros and cons, and how investors can use these strategies to create perpetual wealth. Now, MC, I got to ask you, our listeners have all this wealth of information now. How can they go about executing on this? If they want to learn more about this strategy, where can they get in contact with you and learn even more?
Yeah, so there's a free webinar and a course for 10 lessons, 30 minutes each at yourownbankingsystem.com. So if you want to check out the webinar and work through those lessons, we cover everything in depth in those. And feel free to check us out too at cashflowninja.com. I couldn't agree with you more. One of their statements about the cash flow model versus the accumulation model. You want to have the goose, keep the goose healthy, have many geese and collect the eggs. You don't want to feed your goose and eventually cook it and eat it and then it's gone. So that's how I usually talk about the cash flow versus the accumulation model.
Love it. If you thought that was helpful, please do us a huge favor and leave us a review on iTunes. We'll see you right back here next week for another exciting episode of the Bigger Cash Flow Podcast. Thank you for listening to the Bigger Cash Flow Podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.